Good afternoon, everyone, and welcome to Forager's third webinar of 2017, where we will be discussing the pros and cons of investing in themes. I'm Alex Larkman, and I'm the Business Development Manager at Forager. Today's presentation deals with investment themes, some of their pitfalls, and whether there are ways of separating a good story and a genuinely good investment idea. If you are viewing this live today, you can send us in questions during the course of the discussion. We have set aside some time at the end of the session to answer them for you. But firstly, some important compliance information. We don't know anything about your personal financial circumstances and haven't taken anyone's personal financial situation into account when preparing this information. Everything you see or hear today is intended as general in nature only and does not take your personal situation into account. So without further ado, let me run through the timing of today and I'll introduce you to our panel. The presentation and discussion will run for around 40 minutes until approximately 1:40, and then we have some time for questions. So now I'll introduce the team. Firstly, welcome Steve Johnson, our Chief Investment Officer at Forager. Hi Steve.
Hi Alex.
We are also joined by Gareth Brown, Senior Analyst on Forager's International Fund. Hi Gareth.
Hi Alex. Hello everyone.
And a big welcome to Kevin Rose, Senior Forager Analyst based in New York, who is in Sydney with us for 2 weeks. Welcome, Kevin.
Thanks, Alex. Happy to be here.
So moving on to the topic of the day. Steve, there is a lot of discussion and marketing of theme-based investing, whether it be wind farms, milk, baby boomers or lithium, China, electric vehicles. We all like a story. Why do investors especially like a story?
That Nassim Taleb touched on in some of his books earlier on. He talked about this concept of a narrative fallacy, that our brains are wired to look for a story. And then Daniel Kahneman picked up on this in his research and talked a lot about the fact that our brains are actually quite lazy. We've got this system 1 that deals with things very quickly, and then a system 2 that takes a lot of work and we have to stop and think about things. And he talked in there about the fact that if there's a good story, our system 1 will grab hold of that good story and just run with it, whereas to stop and think about things takes time and effort. And if we're presented with a good story up front, then we don't need to worry about the stopping part.
Evolution's the main explanation, I think. You know, for more than 99% of human history, we didn't have databases, we didn't have libraries. We needed an effective way for lessons to be passed on from one generation to the next. And storytelling is the way that we did that. And it was a very powerful and memorable way to pass on important lessons, but it also makes us suckers for the narrative.
Yeah, I think one aspect of why themes seem so appealing is because, especially in this case, they take something that can be quite complicated, investing, and they make it very simple. You know, as investors, oftentimes we're making an investment case with a number of points. If this business turns around and the company is successful launching into this new market, and they turn around and they sell off this underperforming asset, and point after point after point, it becomes a bit overwhelming. But with the thematic investing, you have one single well-defined bullet point.
And further to those comments, can you each pick a theme that is on your radar today that you think is likely to result in sector growth over the next 10 years? And I'll put that one to Gareth first.
Well, renewable energy is a pretty easy one. It's become a very important part of the energy mix over the last few decades and increasingly over the last few years. And obviously, subsidies was the main reason for getting that tailwind started. But it's got to the point now where these new technologies are becoming very economical ways to generate electricity, and that tailwind is strong and that tailwind will continue. So if we are not using more wind, more solar, more offshore wind 10 years from now than we do today, I'll eat my hat.
Another industry that I think is going to grow, quite confident that it will grow is the digital advertising subset of the overall advertising industry. As with renewable energy, this is not a new theme. It's been a driving force for years, but the main reasons behind its success are still prevalent. You think about the main contributors to its growth. Theoretically, most people have access to the internet. They're using it more and more over time. That's one aspect. The other aspect is digital advertising tends to be very easy to measure, and so it helps companies grow their sales in an effective and efficient manner. And so, there's still plenty of companies, plenty of advertising being spent on traditional channels, TV or print advertising, radio, and I think that digital advertising still has a lot of room to grow as it takes market share away from those traditional advertising channels.
It's going to be really interesting there to see what happens to the whole pie itself, whether that does continue to grow, and there's lots of other different factors changing that. It seems pretty clear that the digital component is certainly continuing to grow. For anyone that wants to read more about that, there's actually a very long and interesting piece in this week's Economist magazine talking about online consumption and where people are spending their time, and a very interesting analysis of the time people spend on their phones in the US versus the amount of times they fart. So that was an interesting comparison there. I'll pick the Chinese middle class, which is a theme that I think a lot of Australian investors have been focused on of late, and it's one that is real. People are getting richer in China. There is a very, very significant percentage of the world's population that has moved from poverty into what we would classify as a middle class. Economists talk about that as $10,000 a year of income, and it is quite clearly having a huge impact on demand for products that are sold into that part of the world. And I think it's one that's going to continue, likely, even if the Chinese economy does suffer. Forager readers have probably read about some of our concerns with the way that economy has been growing, but I think the consumption story is a pretty strong one there.
And some of those investment themes have actually translated into good investment opportunities. Can you talk about a successful investment that has had some help along the way from a theme or tailwind?
Yeah, we don't really have to go much further than that Chinese middle class story. A2 Milk's been a very popular stock on the ASX, and it's not one that we have owned over the past few years, but one that has done sensationally well for investors. And it's not just stock price that has gone up there. The profitability of the business has grown dramatically. It's paying dividends. It's a real story that has translated into economic profits and into a share price that's up many fold over the past few years.
And Kevin, the International Fund has an investment in Alphabet, or Google as most of us know it by. Is the industry growth a big factor in your decision here? Absolutely.
I think when you look at Google or Alphabet, however you want to refer to it as, it's really the 800-pound gorilla in digital advertising. I don't think it invented the digital advertising, but it was certainly the first company to build a successful, growing business out of it, whether it's search or display advertising, video, and now mobile. It's really dominated the space for the last 15 years, and I think, especially when you think about its position in mobile, you look at it and Facebook together, these two companies capture over half of all advertising dollars going into digital advertising. So they're really set up to grow for years to come.
We own Baidu in China on much the same reasoning. So it's a beneficiary of a digital advertising tailwind, but also the Chinese middle class tailwind. So it's got both behind it. But just in case you get the wrong idea, this is not just a technology story. One of my most successful investments was ARB Corporation, which I bought in 2001. They make four-wheel drive bull bars and canopies and various other paraphernalia for fitting out your four-wheel drive. And I bought it because everything had fallen into place and it was a value investment. But the reason I did as well as I did on that stock was because of the tailwind. I think it was something like 20-25% of vehicles sold back in 2001 in Australia were SUVs, and that figure is north of 50%. So that turned what might have been a good or goodish investment into a great one. So that's been a more than 10-bagger for me over a 16-year period.
Yeah, I recently read a book called The Outsiders. It's recommended by Warren Buffett as a very important book for investors to read, and it's a book of case studies about very successful managers over the past 50 or 60 years. And I was skeptical as I read the book. There's a lot of cherry picking has gone on there of after the fact this business was successful, and then we go back and attribute that to the behaviour of the person at the time. But the other thing that struck me was that all of the businesses in that book were in industries that had grown over that period of time. So yes, the management team may have done a good job. Yes, that business probably performed better than other businesses in its sector, but they all had the tailwinds behind them over a long period of time. And I genuinely think that these businesses that, if you want to make 10, 20 times your money over a long period of time, it's almost a prerequisite that that business is going to be operating in an industry that allows it to grow by that sort of magnitude.
So those were all really interesting examples and points raised. But if I look across the portfolio at Forager, these types of businesses seem to be the exception rather than the rule. Can you explain why Forager perhaps thinks less about themes than other fund managers?
Yeah, well, the problem with a really good story is that it tends to come with a high share price. And we tend to be skeptical on a few different fronts. The first thing to think about is the change going to happen as quickly as everyone thinks it's going to happen? And this is one of my favourite Bill Gates quotes. He says, most people anticipate change happening much quicker over a 2-year period and not quicker, they think there's going to be a lot of more change than there actually is in a 2-year period and a lot less change than there actually is over 10 years. And a lot of these things tend to take longer to unfold than people think, or in some cases they don't unfold at all. So we tend to be skeptical about these things, and we tend to be looking for businesses that we also think are cheap, and that doesn't often come with a theme behind it.
And Gareth, do you have anything to add to that topic?
Yeah, look, moats still matter. To bring up an example, I wrote a piece for Intelligent Investor many years ago about the Graham Society, and this was before the retirement home industry sort of blew up in this country.
We're talking 2004 here, back when Gareth and I were working together at Intelligent Investor. There was a real boom in aged care living stocks, and the whole theme was that the population is aging and we're going to need more and more accommodation for those older people to live in. And the theme was reality. It has unfolded like that, and there are more old people now, and we have needed more accommodation.
So the issue there is there was a tailwind. The tailwind was real, but moats absolutely matter. And what I'm talking about there is the competitive advantage. I mean, a good story, a good tailwind attracts a lot of competition. And if a company doesn't have a lock on its customer, that competition will come and it will revert those returns to average at best, and in some cases to blow up. And that growing population is an example. The capital flooded into the retirement industry, and none of the competitors there had a lock. So it got very, very competitive, a lot of debt involved, and it blew up. Now, over the exact same period of time, the exact same tailwinds were helping the funeral home operators, and the funeral home business in Australia is a very, very different competitive dynamic. The biggest player has a very good competitive position, and those stocks did really well over that same period. So they're exposed to the same tailwind, two very different outcomes.
So it's the first thing we really think about is the trend real? Is it actually going to unfold the way people think? Second thing we think about is, does the business have the ability to capture a good chunk of that growth because it has some form of competitive advantage? If you can't identify a competitive advantage, then the growth is not necessarily going to translate into economic returns. And then the third really important thing that we think about is what the current price implies about that future growth.
So Gareth, you and Steve were in Europe recently, and you came across a big focus on electric vehicles, or EVs there. Could you tell us about that?
Yeah, well, our first visit was to Norway, and that was really interesting because it is the Tesla capital of the world. There is a lot of Teslas on the road, and that was strong contrast to the oil and gas industry conference that we were at the time, where people were talking about the threats from electronic vehicles to the oil industry. And then after that, we went to Munich to another conference, and just about all the German companies there had a slide in their presentations talking about electric vehicles, and whether from an angle of it's a threat to our business or it's an opportunity for our business. And it was just interesting to see that. I'm very confident that 10 years from now there will be more electric vehicles on the road than there is today. I'm not confident that Tesla's going to be in a dominant market position, and even if I had that feeling, I'm still not sure today's price is the right price to be paying for.
Yeah, I think with value investing, everything comes down to price at some point, and you look at the stock price graph for Tesla, and it illustrates this point very well. This is I think, as the stock price has really moved up over the last few years, I think most investors are expecting what it was safe to assume is a best case scenario. The implied enterprise value for Tesla of around $60 billion, it's almost half the enterprise value for GM, and yet it produces not even 1/100th the number of cars as GM. This last quarter, Tesla produced 20,000 vehicles, GM made 2.3 million. So clearly the market is extrapolating a level of future success that's multiples beyond where the company sits today. And I think that's oftentimes a problem with thematic stocks, is you're paying a hefty price for the story.
Another sector that you've been writing a bit about on the blog, Kevin, is wearable tech, is another one where the hype has got a little bit, perhaps a long way ahead of it, or certainly that was the case 12 months ago. We've seen the stock prices come back some way since then, but it's another sector that you think is probably overhyped.
Yeah, I would definitely agree with that assessment. I think you look a couple of years ago and you take a company like Fitbit, which was really the first one to trumpet this idea of wearable technology and the products they had out at the time, and they had great results early on, and you look at the results over the last year and a half, and they've really struggled. I think a couple of things have happened. Perhaps consumers to some extent have decided that it's a bit of a fad, and so you've had demand not really reach expectations, but you've also had a whole slew of competitors come in, whether it's Apple, Samsung, Adidas, Under Armour. There's just a lot of options for those types of products now. So I think, we think a lot about industry structure and competitive advantage, and even times when you see strong growth behind a theme, the industry structure just doesn't allow companies to make profits, and ultimately stock returns suffer.
I mean, the airline industry is probably the best example over a long period of time of one that's had tailwinds is probably the right word, but a huge amount of growth in terms of the amount of passengers that are catching aeroplanes, and the correlation with GDP is GDP goes up, number of people traveling goes up by 1.5 times as much, and that has been going on for a very long period of time, and yet you've got a whole sector there that really hasn't made a cent. And historically, the automobile industry has been a pretty difficult one to make money out of as well, so it's going to be very, very interesting to see whether Tesla can generate meaningful profits at all, let alone enough to justify a 60 billion market capitalization. So as good as themes can be, and I think as much of a tailwind as they can be for a good investment story, it is something to be really skeptical about. It's very important to think about competitive advantage. It's very important to think about the amount of capital that is coming into a sector and trying to chase that story, and it is fundamentally important to think about what price you are paying today relative to what you think that future growth is going to be.
So the issues there is, how much do we pay for a theme? What's already priced in? And did you get there early enough? We touched on this earlier, but Forager has had quite a bit of success at the other end of the spectrum, buying into out-of-favour sectors. Can you explain when and how you invest in that way?
It's really taking that whole argument and flipping it on its head, that because themes are so popular, because so many people like investing in a story, because as a fund manager, it's much easier to sell a good story to your clients than to tell them that you're buying a business that you think is in decline. We tend to find a lot more value at the other end of the spectrum. We tend to find that our best opportunities are in stocks where the story is perhaps not great, or certainly the perception is not great in the short term. And The best example over the past few years is mining services investments here in Australia. We've had the odd disaster in that sector, but overall it has been very, very profitable for us, investing in a sector that went from really being a growth story and a positive theme at one point. Chinese economic growth was supposed to drive the Australian mining industry for many decades, and the services companies were going to benefit, to the mining industry is in a funk and it's never going to grow again, and these companies are never going to earn a reasonable return on capital. And a business like McMahon went from trading at a premium to its book value down to trading at 25% of its book value. We started buying that at about 10 cents, traded down to 5, and you sit here today at 23 or 24, and you've made off the bottom 5 times your money, and probably off our average purchase price 3 or 4 times your money, out of a business where the theme has actually not been fantastic at all. So we tend to, because the psychology is so strong in terms of people wanting to invest in stories, we tend to actively seek out places where the story is not so good. And it has been a very successful investment strategy for us over the years.
Another example is Italian small cap stock LN. The secret here is actually the narrative that we thought was most important was pretty good. LN is a company that makes lasers for use in aesthetic and medical machines, and it also makes lasers for use in industrial settings. And it's actually a growth industry, and we could see that. But the dominant story that the market was focusing on here is this is small cap, this is Italian, this is stuck in Europe, this is slow growth. We're not going to make great returns, and there are lots of risks to worry about, which presented an opportunity for us.
Yeah, and I'd say that's probably been true of most of our successful investments. It hasn't been flying straight into the wind of something that is in decline, but it's been about trying to find stocks where the stock price has been caught up in a negative thematic, but where we don't think it is actually as important for that business as the market has believed. And Kevin, one of our recent investments in the US that's been very successful for us is one that fits that bill perfectly.
Yes, Cable One, I think, illustrates that point very well. Cable One was a US cable TV operator that we owned in an international fund. And a popular theme in the US, especially in the press over the last 5 years, has been this idea of cord cutting. The idea that consumers have been canceling their traditional cable TV subscriptions as prices have been going ever and ever higher, and especially recently as alternatives have become available, such as Netflix and other streaming services. So I think when we started to look at Cable One, this is a business that had been recently spun off. The stock price had more or less stagnated. It hadn't gone anywhere since the spin, and investors were very concerned with how it would sort of navigate through this time when customers were getting rid of their cable subscriptions. As we dug into the company, we realized that yes, that would be a negative trend, but they had other businesses, the main one being selling internet service to the same customer base, which we thought was going to be even more powerful and was being underappreciated at the time.
It's that word that you put in the middle of that sentence there that you'll often hear from us. It's the but, and it's bringing some of that complexity back into the story that you touched on right at the start of this conversation. You know, everyone has the one theme and they think the business is going to go this way, and we really look for those situations where perhaps the situation is a little bit more complicated, perhaps there's more to the business than people perceive, and perhaps that theme is being overplayed in terms of its importance for the business. And now, I remember when you sent that piece of research around to us on Cable One, the story was a pretty straightforward one in terms of why that theme was wrong, that people want to watch Netflix, they're going to need a high-speed internet connection, and this company owns the pipe into the house, and that they're going to be able to make money out of this, whether it's selling cable TV or whether it's selling internet. So it was really, in that case, a miscategorization of that business, that it was a cable company rather than an infrastructure company in that particular example. And you'll see even when we write our reviews of stocks in the quarterly reports and things, we tend to lay out the bear case for something and then say but, and it's what comes after that but that's really important, and trying to weigh that up against what may perhaps be a negative trend.
Thanks all. Some interesting sectors covered there. So what are the risks for someone who wants to invest in these types of businesses though?
Yeah, I've had a lot of questions over the past few years about investments from Forager in things like traditional media or retail at the moment. And I think we think long and hard about those questions asked at the start about whether the trend is real and whether it's happening and what its impact is going to be. And I love that Charlie Munger quote from the Berkshire AGM quite a few years ago now, but he said it's hard to pay a low enough price for a business in decline. And I think that's really true. And I think it's applicable to quite a few industries and businesses at the moment.
Yeah, what Steve's talking about there is the classic value trap. We'll have a look at Fairfax now. This is obviously the Australian media organisation. That chart that's in front of you doesn't really tell the full picture. If you stretch it back out to a full decade, back to 2007, the stock's down something like 80%. And even that's not the full picture because they've had an investment in Domain that's gone gangbusters over the last decade. And so the core media masthead business is down something like 95% or more, I'd say. It's been a value trap, and there's never, actually over the last decade, there's really never been an intelligent time to invest in Fairfax, even though it has looked on the face of it cheap at times.
Another example similar to that is the traditional physical retail sector, and the company here we put up, Sears, is a great example of a company that has not been able to overcome this theme. I think Sears is one of, for over a century, it's been one of the preeminent retailers in the U.S. Had a great brand, a very large portfolio of valuable real estate. It seduced a lot of intelligent, smart investors, but at the end of the day, this theme of the decline in retail has just been more powerful, and everyone underestimated it. And unfortunately for Sears, they didn't have any other assets or anything else that was able to overcome that decline.
We sat in this room yesterday actually talking about trying to find some potential anti-narrative stocks, and the Amazon's coming to Australia theme has been very strong of late, and we were asking Kevin the question of which retail businesses have done best surviving against Amazon in the US over the past 10 years, and I guess I'll let you answer that yourself, Kevin.
There aren't too many survivors. I think, when Amazon sets its sights, it doesn't take any prisoners, and the Amazon effect is real in terms of how I see it in the US. I think historically, at least up until recently, the grocery business has been able to withstand to some extent, but people love the convenience of shopping on the internet, and apparel, retail, and other consumer goods companies, they have not fared very well.
Yeah, and I think particularly in the value investing world, but people use these heuristics like a price-earnings ratio, and I think in general the range of numbers that people apply to things is not wide enough. People think 8 times earnings is cheap for a business, and even a business in moderate decline, you're going to do quite poorly paying 8 times earnings for something that shrinks at 3 and 4% a year. And if something's going to shrink at 10% a year, you can pay 3 and 4 times earnings and still not do very well out of it. And at the other end of the spectrum, you can pay 20 times earnings for a good business that grows for a long time and make exceptional returns from that entry point. So I think it's really important when you're thinking about these thematic investments that there is a wide range of multiples that you're prepared to pay for a business. And, if it is something that's going to shrink, that you're thinking long and hard about what impact that is going to have on your valuation. And we don't do complicated DCFs very often at Forager, but you really do want to be thinking about this concept of how to value any stock, really. And we use this slide in a lot of our presentations to talk about valuing growing businesses or shrinking businesses or businesses that are going to stay the same. You need to be able to answer these 3 questions. How much cash are you going to get? When are you going to get it? i.e. how much time is it going to take? And how sure are you that it's actually going to turn up? I think another issue with some of these businesses that are in decline and where the the thematic that is facing them is real, is that you sit there and you say, well, it's going to make a profit of $100 this year, and that is worth $100 to me as an investor. And really, it's rare that that money comes out. You know, you get a board and a management team that doesn't like the fact that their business is shrinking, and they tend to want to take the profits and invest it somewhere else and do something else with it. So focusing not just on how much money the business is going to make, but how much of that money is going to come back to you as an investor is always important. It's especially important in a business that's going to shrink. It's
very rare to find that managerial skill necessary to profitably shrink a business.
Yeah, absolutely. When are you going to get it is important. You think a business is going to turn around, but if it's going to take 5 years, that's worth a lot less to you than one that's going to turn around in the short term. And how sure are you that this business is actually going to survive and that you're going to get that cash in the future? So we're really trying to answer those three questions. And you'll see in our portfolio, we've actually avoided a lot of these businesses that we think are in genuine decline, because although we are prepared to invest in the anti-narrative, we're careful about when and how we do that.
So, from our discussions, it seems like there are risks to both styles of investing. Do you have any rules of thumb that we can use?
Well, I think there are two ends to the spectrum here. So there are some things that we've talked about today that, you know, if you are investing in a theme, some things to think about. And at the other end of the spectrum, if you want to take the other side of the argument and go looking for things that people are particularly pessimistic about, there's some risks and things to think about on that front as well. So maybe, Gareth, if you start with the, I guess what we call the growth stocks.
Yeah, so if you're investing in a business with growth potential, there's a few questions you need to ask yourself. The first is this really a growth industry? There's a huge amount of loss created by investors mistaking cyclicals at the top from growth stocks. And the first thing you want to make sure is you're dealing with a genuine growing business. Secondly, how sustainable is that growth? Are we going to grow above average for 20 years, for 10 years, for 3 years? And we need to be conservative in our calculations here. The third thing I'd say is, what sort of competitive advantage does the business have? Does it have a lock on that particular tailwind in which it's hoping to harvest? You know, otherwise other capital is going to come in and it's going to destroy your outsized returns. And then, of course, we need to recognise that price is what you pay and value is what you get. What are we paying for the stock today, and is that reflective of a bargain for the growth we will get? And lastly, I'd just add, are the management incentives right, especially with a fast-growing business? Well, maybe not especially, but with a fast-growing business like any other kind of business, management incentives really matter, and we need to make sure that they're incentivized to row in the same direction as shareholders.
And then on the other side of the coin, if you determine you're looking at a stock that's fighting against the theme, the idea of this anti-narrative, I think there tends to be two different paths these companies go down. Sometimes they're facing short-term cyclical type challenges, and then other times they're facing more long-term serious structural disadvantages. So I think it's important to understand which type of company and which type of path you're looking at. And then, you know, if it's the first case, cycles tend to be self-correcting. But it's important to look at the balance sheets of those companies to see if they're strong enough to survive through the cycle, if they have the wherewithal to get through the bottom. And then if it's, you know, if it's a company that's facing a longer-term structural challenge, then it's important to decide whether or not the company deserves that perception. Is there more to the company than just the business that's in decline? You know, as we talked about a few different examples, oftentimes there can be hidden assets or other businesses below the surface that are underappreciated. And I think I agree with the idea of incentives. It's important that management is incentivized to guide a company through a difficult time, because oftentimes it's a very different endeavor than driving growth. And so you want to make sure that management is aligned with you as a shareholder.
Yeah, we've often actually seen in some of our success stories that if a company goes from restructuring and decline and manages to turn itself around and grow again, it can often be a different person or a completely different set of incentives. And we've got that point on the chart there on both sides of the equation. Are the incentives right? The point here is that you want those incentives to be different for the different types of businesses. You know, some of the things I see go wrong in the growth side of things is that management is incentivized just to grow the top line and to issue a lot more shares, and you don't see that revenue growth translate into earnings per share. And then on the other side of the equation, I already touched on this, but you've got a business in decline. You want that cash to come out to shareholders, and you want to make sure that management are incentivized by doing the right things, and if they sell a business and give you the money back, that they're going to participate in that profit as well. So you really want to look for and I guess push those companies to think about those different types of incentive structures depending on the different types of businesses that they are.